The outdated response of globalized, supranational, centralizing institutions to rising gold demand since 2020 stands in stark contrast to the decentralized ways gold can now be acquired, such as through blockchain. This shift, combined with the global multipolar realignment, the BRICS, and gold's formal return as a tier one asset under Basel III, ironically established in their own system, in their own backyard, with them bearing witness to it happening, signals deep structural problems at the top. The world has changed. It's time for the gold business model to adapt to those secular global changes.
Welcome to the Morning Markets and Metals with Vince Lanci, where each morning Vince brings you the financial and precious metals news to get you ready for your day. And now, here's Vince.
Good morning, everyone. I'm Vince Lanci, and this is the market rundown. 10-year yields are 453, unchanged. The dollar is 108. Spot 02 up 9, almost 10. The S&P 500 is 60.70, up 1.5 to 2 handles. The VIX is 1593, bottoming at 15 consistently now as opposed to 12. That's an analysis we saw yesterday. It makes a lot of sense. Gold 28.73 down 23 and change. Silver 31.67 down 14. For those of you interested, we're completely out of our silver spec position. We do have a significant long gold short tech position, which is not doing well right now. All right. Copper 459 and change. Up a half a percentage point. WTI 72.76, down 75. Nat gas 368, down a penny. Bitcoin 96,500, 96,600, up a little less than 1,000. Palladium 971, down 6. Platinum 990, up 7. Gold, silver hovering at 90. Very stubborn. This might continue until they find the gold. Soybeans 1035, down 8. Corn 478 down 1, wheat 586 down 1. The LBMA addresses London bullion availability concerns. We had registered for a webinar that the LBMA was holding early this week, and unfortunately we're not able to attend. We do have a copy of the video, and we have created a transcript for it. And we will be sharing that with Premium when we've gone through and made some more deeper analysis of what was said and how it was said. Today, so we haven't watched it in full yet. Today, we'd like to start by giving a big hat tip to someone on X, a social media person, a mutual PM Bug. PM, I would assume, means precious metals. He also has a website. He took notes during the webinar. And from what we've seen of the webinar, the recording of it, they're pretty good notes. And we have used that, plus our own notes, to give you a cursory recap of how it went, with a couple extra color comments put in there. This is not a partisan read. With regards to the metal itself. So the LBMA addresses London bullion availability concerns. And the premium portion of this post is the notes and analysis on that. So it's kind of like a behind the scenes stuff, more than you bargained for. Front page, gold, someone is being slowly walked to the gallows. We mean that. It could be a producer. It could be a bullion bank. It could be an executive at the LBMA, but someone's going to hang for this. Addendum, the catalyst is Basel III. We believe, although Basel III is not necessarily the reason for it, we believe the tipping point catalyst is probably the tariffs. Oh shit, we better do this right away. But the reality of it is July 1st is Basel III implementation in the US. And so if there's a daisy chain and metal going on, if there's double claims going on, if there's poor logistics from just-in-time inventory management, well, that's going to come to a head very soon. Gold fixed PM getting squirrely. That was us saying that we're a little bit nervous about the market. TME had noted the potential for a shooting star, and we looked at it and said, that makes a lot of sense. Not a reason to get short, but certainly a reason to take profits, and that's what we did. All right. The main story, the LBMA addresses London bullion availability concerns. All right, there's a picture from their website. All right, we're going to go through it hopefully quickly. There's a bottom line that we're going to lead with. This is our bottom line, what we think happened. Uh, then we're going to list the questions that they uh, addressed, whether implied or real questions, and then put a little more meat on it. So the bottom line is, if you're just tuning in, is the LBMA's stance on gold availability and market mechanics remains debatable. Uh, while they insist on ample supply, market movements and pricing dynamics suggest deeper underlying pressures. The LBMA asserts it is simply responding to wholesale panic, and the delivery issues and delays are merely stresses of what I would call a Six Sigma event, caused in no small part by the unpredictability of the Trump administration's policy around tariffs. Some believe, like Daniel Ghali of TD Bank, the free float of gold in London is less than assumed, and the U.S. repatriation, for whatever reason, has revealed this shortfall as a smoking gun and the cause of the logistics problems. All right, so that's where we are. So the LBMA is addressing that in their webinar. Here's the questions they addressed. Number one, is the gold market functioning as intended? Number two, what is the supply source breakdown, London versus refiners? They believe that the COMEX vault inflows over the past months have been evenly split. We'll get into who the split is in a second. Who is taking London metal? Hedgers with net short positions on COMEX are the primary actors securing London metal. LBMA's secure official position on metal availability. They denied any shortage of physical gold, attributing delivery delays to logistics rather than supply constraints, which is the crux of this whole thing. What about silver? LBMA executives pretty much openly mocked the silver squeeze narrative, gave some reasons behind it. Then you can derive what you want from that. What is gold's relationship with global trade? Almost like a throwaway question. One LBMA official commented that gold tends to rise when global trade contracts, stating that trade is currently shrinking. I'm not so sure I agree with that. Gold tends to rise relative to stocks. It doesn't always rise in a stagflationary environment. However, when it does, people will get their faces ripped off. So putting a little bit more meat on the bone before we get into our own very quick assessments. Essentially, LBMA executives maintain that the gold market is functioning as expected, attributing the recent surge in gold and silver shipments from London to COMEX in New York to tariff concerns. According to their assessment, COMEX vault inflows over the past months have been evenly divided. Half sourced from London's gold stocks, and the other half supplied by refiners shifting from LBMA standard to COMEX standard bars due to higher premiums in New York. I'm going to pause my own script there for a second. Why not 100% from London stocks? Why do they have to go to refiners at all? That's the contradiction in that. And it's an honest contradiction. Moving back to what I wrote. The primary actors acquiring London metal appear to be hedgers with net short positions on COMEX, looking to secure physical gold. The LBMA denies any shortage of physical gold, instead attributing delivery delays to logistical bottlenecks rather than supply constraints. However, this assertion remains controversial as they also challenge analysts' estimates of free float gold, claiming nearly all vaulted gold is unencumbered and available for trade. So we'd have to ask people to define what they mean by available for trade is. My gold is available for trade at a price, right? It's not available until it's available. Discussion on silver was minimal, and they said there was plenty of silver, The logistics are a little bit more difficult to get due to the industrial nature of it. And uh, just to give you a quick comment on that, that's because they're trying to find it. Silver's not centralized anymore, and they openly laughed, and that's incredibly arrogant because it's their dismissiveness of the decentralization of the supply of silver that is causing this problem. And it's undermining their credibility while the Shanghai exchanges are rising in credibility. Protect your franchise, boys. Okay. One official did remark that gold tends to rise when global trade contracts, adding that trade is currently shrinking. The validity of this claim remains uncertain as it does not account for alternative trade channels outside SWIFT, particularly those utilized by BRICS countries. Are we going to slow down or not? That's really what the question is there. All right. There are a lot more comments, a lot more notes from that, some of them from PM Bug, some of them from the things that I saw, and I have those in premium for you. I'm also going to include the link to his as a source. He's got a nice little big long paragraph that explains it pretty well. But look, whether the issue, at the end of the day, whether the issue is a lack of immediately available metal, logistic constraints, or both, one thing is clear. The outdated response of globalized, supranational, centralizing institutions to rising gold demand since 2020 stands in stark contrast to the decentralized ways gold can now be acquired, such as through blockchain. This shift, combined with the global multipolar realignment, the BRICS, and gold's formal return as a tier one asset under Basel III, ironically established in their own system, in their own backyard, with them bearing witness to it happening, signals deep structural problems at the top. The world has changed. It's time for the gold business model to adapt to those secular global changes now. I know that they've made some moves to try and get more access to the demand so they can get a better feel for the flows, kind of to re-centralize the decentralized gold demand with technology and blockchain and more advanced ways of aggregating. Good. That's what you're supposed to do. News and analysis. Breaking: China insurance companies will now buy gold. We describe that as potentially like what Reagan did in the 80s when he deregulated stock ownership by companies, uh, along with investment banking. Gold, someone is being slowly walked to the gallows. We mentioned that. Special signs of a top emerge. That was our comment and why we got off the dime and sold. Gold Fix PM getting squirrely, same idea. All right. We're going to skip the markets recap and market news and geopolitics. We're just trying to get this out on time today. The number is out right now. It's 8:34. So that's CPI. So CPI is today, PPI is tomorrow. And we'll look at the markets in a second on that. All right. So premium. So I'll just give you a quick screenshot of this. Right. You can take a quick look at that. So there's more bullets, more notes that we took, but we did not say. And there's the premium right there. All right. And we're going to throw in a report from a bank. Let's take a quick look at the markets and we can go. Since you're definitely going to be watching this after CPI because I just witnessed it coming out, CPI came in extremely hot. CPI came in at 0.5 month over month, expected 0.3. That's really hot. CPI core down 0.4%. I'm sorry, at 0.4%, expected 0.3. CPI 3% year over year, expected 2.9. That's a big beat. What does that mean? Well, it means quick reaction. It means Powell's justified in data for not easing. It means Trump's going to be more miserable than ever. It means it's going to be really hard for him to get his job done. Everything that Trump wants to do will everything that Trump can get done will be tied to him getting a weaker dollar. And you just cannot get a weaker dollar with the Fed refusing to ease to fight inflation. So my guess is traders who are looking for the next rate cut that was going to be in, say, July, have moved it out to October. They're probably going to kick it out to December. There may not be a rate cut for the rest of 2025, the way things are going. And now you're looking at the markets there. Here's a little bit of hope for you. Given the fact that it just became pretty much metaphysical certitude that the Fed's not going to ease, gold down only $30 is a gift. Now, call me in about 2 hours and we can see if gold's still down only $30. But take a look at silver, only down 22 cents. That's pretty cool, considering stocks are down 62 handles. And the dollar is once again screaming higher. Gold should be a lot lower. Silver should be a lot lower. Are they oversold and that's why they're holding? No, there are still physical fears out there. I will say this to you as a contrarian, it's popping in my head right now. If Powell's not going to ease because of CPI, then Trump's not going to do any more tariffs. Okay, that's my take. Trump can't do tariffs unless he can get a weaker dollar. Now, he may do it or threaten it, but ultimately how it happens is how it happens. And Bitcoin is taking it on the chin like a tech stock. Oil doesn't care. All right, I'm Vince. Catch you later.
Well, thanks for watching this morning's Markets and Metals with Vince Lanci. We sure appreciate you tuning in and starting your day with us here. Hope you enjoyed the show, and we'll see you again tomorrow. Please note that this video is not intended as legal licensed financial trading advice and is to be used for informational purposes only. Please contact your financial advisor before making any decisions, and thanks for watching.